Hi everyone. It's a pleasure to be here with you today at the Australian Securitisation Conference. So for many years now, the Reserve Bank has been invited to present at this annual event, and the securitisation market regularly delivers plenty for us to discuss. So the Australian asset-backed securities market is an important source of funding in Australian financial markets, particularly for non-bank lenders and the borrowers they serve. For investors, it offers exposure to an increasingly diverse pool of issuers and products. Today I will be mainly talking about how the securitisation market has evolved over recent years. To summarise, securitisation markets have continued to adapt to large changes in financial conditions. While securitisation pricing has responded sharply to tighter monetary policy and total credit growth in the economy has slowed, overall securitisation issuance has been maintained at high levels. Underpinning the strength in issuance in recent years has been the non-bank sector, which has seen new entrants and existing lenders quick to switch attention to different borrower segments to support lending growth. Against that backdrop, I'll wrap up with thoughts on a few things to watch for the period ahead. So, in recent years, there have been big swings in ABS pricing, along with broader financial conditions. The onset of the pandemic was an anxious time for all, including securitisation markets. But the recovery in sentiment was swift, amid comprehensive policy support from governments and others. Within a year or so of the support measures announced from March 2020, including the Reserve Bank's comprehensive package, yield spreads to the bank bill swap rate on AAA-rated ABS deals had halved to reach the lowest levels since the global financial crisis. Okay, there it is. The lines in there just show some of the policy actions there, March 2020, when the package came in and the sharp decline in spreads. And also with BBSW and very low levels, these were very low borrowing costs. By late 2022, however, so after the policy tightening had commenced, these ABS yield spreads were back to or above their level at the start of the period. So spreads peaked not long after the commencement of the cash rate tightening phase in May 2022. They have moved lower since. So the big swings were evident in the AAA-rated notes of both RMBS and other ABS. They're even larger for lower-rated mezzanine debt. Relative to past experience, you can see that the movements in AAA-rated notes are largely contained to the broad range that we've seen post-GFC, but the speed of the adjustments was unprecedented in the post-GFC period. Overall, though, securitisation issuance has been resilient to the shift higher in spreads and the tighter financial conditions in recent years. So annual issuance has been broadly maintained at around $50 billion over 2022 and 2023, which is around the same level reached in 2021. This has occurred even as system credit growth has slowed, so it was around 9% a year ago to around 5% more recently. There are two broad shifts underpinning the strength in issuance throughout this period. One is increased issuance by non-banks, and a second, related development, is growth in different types of loans being securitised. I'll talk through these developments in turn. So increased issuance by non-banks. Well, non-bank lenders are the major issuers of ABS in Australia. This is not a recent development, but it has become more pronounced in recent years. So for many years, banks were the main issuers of asset-backed securities, so that non-banks accounted for around 1/4 of issuance. As we can see in this chart here, the non-banks being the green shaded area. This began changing around the mid-2010s. This partly reflected banks reducing issuance as they turned to other lower cost funding markets. And partly it was non-banks increasing issuance as they grew their lending at above system pace. Non-banks continued to increase their share of issuance through the pandemic period, and they now account for around 3/4 of ABS issuance. One reason for the further increase in the non-bank share of issuance during the pandemic period was that banks weren't issuing much wholesale debt at all. The Reserve Bank's package of policy measures was a big factor behind this. In particular, the Term Funding Facility, or TFF, offered low-cost 3-year funding to banks between April 2020 and June 2021. It ultimately provided $188 billion in funding to the banks. As intended, this reduced their funding costs and helped them lower costs to their borrowers. Banks' lower funding needs were reflected in their much reduced issuance across senior unsecured debt, covered bonds and asset-backed securities. As you can see in this chart here, where you have the shaded area denotes the TFF drawdown period. In particular, there was no issuance of asset-backed securities by the major banks during the TFF drawdown period. The relative absence of bank debt across markets was one factor encouraging investors to purchase ABS as an investment with some comparable qualities. Once the TFF drawdown period ended in mid-2021, mid-sized and smaller banks increased their issuance of ABS. The major banks, however, have issued very little over much of the past 2 years. Wider spreads in RMBS markets over that period have made RMBS issuance less appealing for banks compared with those alternatives of senior unsecured and covered bonds. That said, in recent months we have seen some more activity from the larger banks, including a large public deal by one of the majors as spreads have narrowed. Given their increased use of senior unsecured and covered bonds, diversifying funding through RMBS may be more attractive at the moment. The second reason for the increase in non-bank market share of ABS issuance has been an increase in the number of non-banks issuing into that market. So this year, around 30 different non-bank lenders have issued ABS. That's a threefold increase from the number about a decade ago. So that's the green line in the top panel there. In contrast, the number of banks issuing ABS has declined over the period, with about 10 banks issuing this year. One consequence of these new entrants and shifting practices is that concentration in the securitisation market has fallen, particularly for non-mortgage ABS. So now moving on to the lower panel, about a decade ago, the top 4 issuers of non-mortgage ABS accounted for nearly all issuance. Today, they represent about half of the issuance. As a result, concentration in the non-mortgage ABS market is now similar to that in the RMBS market, after being consistently higher for many years after the GFC. Third reason for increased non-bank issuance, as hinted in the preceding point, is that non-banks have been expanding issuance outside of prime RMBS to non-prime RMBS and other ABS. So looking at housing, favourable funding conditions and a strong housing market during much of the pandemic period supported non-bank lending. Annual system housing growth increased from 3% at end 2019 to around 8% by May 2022, and non-banks were able to increase their share of the housing credit market. As spreads on RMBS narrowed, non-banks were able to be more competitive on loan rates. And for prime borrowers, one important feature of non-banks was their fast turnaround times. Amid rising house prices in 2021 and early 2022, borrowers worried about missing out were willing to accept somewhat higher loan rates to secure a faster approval. Reflecting this environment, non-bank housing credit was growing about twice as fast as bank housing credit during those years, that being the green line in the upper panel there relative to the banks in beige. Now, as interest rates started increasing in mid-2022, funding costs for financial institutions increased, but it was by more for non-banks than for the banks. While non-banks source most of their funding through ABS in capital markets, banks have access to lower cost deposit funding, which tends to reprice more slowly. This made it more difficult for non-banks to compete on price with banks, with loans from non-banks becoming more expensive. In this competitive environment, external financing increased to record highs, driven by borrowers searching for better deals on offer from a range of lenders. Much of this refinancing activity has flowed to the major banks, consistent with major banks offering rate discounts and cashback offers that non-banks were not able to match. In fact, the interest difference for new loans between non-banks and banks widened from approximately 40 basis points during 2021 to around 100 basis points in December 2022. In addition, the housing market started to cool, meaning that borrowers were less worried about missing out and therefore less willing to pay a premium for fast turnaround times. And the banks started lifting their game there as well. In this environment, non-bank housing lending slowed and has been contracting since the start of 2023, while bank housing credit continues to grow. The decline in mortgage lending by non-bank lenders has naturally resulted in lower RMBS issuance. This has been driven by prime RMBS issuance, which, as you can see from the top panel in red, has fallen over 2023 to be, so far, around half the pace of the preceding 2 years. In contrast, and reflecting the change in non-banks lending focus, their non-prime RMBS issuance has increased by about 50% over the same period. So that's the purple bars in the second row there. It's also the case that non-banks have expanded personal and business lending and increased issuance of non-housing ABS, as you can see in those lower panels. So another part of the response to these competitive pressures is that some non-bank lenders have focused on personal and business lending, either as a new interest or growing an existing business. In particular, lenders have identified auto loans, personal loans, self-managed super fund mortgages and specialist mortgages as growth areas where competition with banks is less intense. Within personal lending, auto loans have certainly been a hot segment of the market. So I've got a chart on that here with a couple of, we've got personal credit growth from select auto lenders up in the top panel and new auto sales down below. So new auto sales have picked up materially since the pandemic. They were still growing at around 16% for households in the year to October 2023. And in contrast with housing lending, so back to this chart here, focusing on the lower panel this time, non-bank business lending has continued to grow faster than bank business lending. As a result, non-banks have increased their market share of business lending at a time when business credit growth remains higher than for housing credit. In aggregate, the difference between interest rates that non-banks and banks charge small business have not moved as much as for housing. Also, some market participants suggest that tighter financial conditions have pushed more businesses, particularly smaller businesses, outside bank risk tolerances, given the associated prudential requirements. Now, some portion of this non-bank business credit is financed through securitisation markets. Turning to another area of interest, building on the earlier slide, non-bank issuance of auto and equipment, ABS or A&E, is the key category of non-mortgage securitisations. And this has risen to record levels over 2023. This is a segment of the market where non-banks have been the key issuers for a number of years. So once again, the non-banks are featured in green there. So the major banks have not issued, at least publicly, an A&E ABS since 2018. and other banks have not issued since the first half of last year. Despite this, the number of issuers of A&E securitisation has increased steadily over the past few years. Some of the new issuers are non-banks that have entered the market after acquiring lending businesses from banks that have left the market. In 2023, a record 15 lenders have issued A&E ABS, with 3 being new issuers in this segment. So who's buying it? Of course, high and steady issuance requires willing investors. Available data suggests that the investor base remains spread across foreign investors, banks and, to a lesser extent, super funds and other similar long-term investors. We hear from investors in liaison that they like the increase in the number of issuers and the diversity of ABS collateral types in recent years. Investors also like the diversification associated with having ABS backed by personal and business loans, since there are more loans than in an RMBS due to smaller loan sizes, so that reduces the exposure to individual borrowers. We also hear in liaison that issuers, and non-banks in particular, have put a lot of effort into expanding their investor base, especially overseas. One example is dual currency deals, which are designed to appeal to foreign investors that otherwise may not buy Australian paper. The idea here is that some foreign investors may find it difficult to hedge the AUD exposure back to their domestic currency due to prepayment risk, and the foreign currency tranche removes that barrier for the investor. While the issuer may face a similar challenge with hedging, the issuer knows the asset pool better, so arguably it's in a better position to manage the risk than the foreign investor. Good credit performance to date and a broadly favourable outlook continue to support investor confidence. The sharp increase in ABS spreads during the earlier phase of tighter monetary policy, particularly around the instability that we saw from overseas banks, suggested some investor caution, particularly with the potential for rising housing repayments and declining house prices to weigh on housing loan performance. However, to date, unemployment has remained low. House prices have turned around and, in aggregate, housing loan arrears have not increased much from their very low starting point. Looking ahead, now the big swings in economic and financial conditions in recent years are good reason for humility when opining on what might transpire in the period ahead. So I'll restrict my crystal ball gazing to suggesting 3 areas that might be topical for discussion at this conference next year. First, developments in credit quality fundamentals. As outlined in the bank's latest statement on monetary policy, the board's priority is to return inflation to target, but risks on either side remain. Repayments are an increasing share of household income, and unemployment is forecast to rise. And the risk characteristics of the ABS market facing that environment have changed. By product, there's less prime RMBS and more non-prime RMBS and non-housing ABS. And by issuer, there are more non-banks. The Reserve Bank's latest financial stability review concluded that the outlook for non-banks' housing loan quality is more challenging than in recent years because some are relaxing lending standards and have found it difficult to retain more creditworthy borrowers in an environment of heightened competition with the banks. Second potential area of interest is funding conditions around the remaining TFF maturities. So around $80 billion of the TFF funding provided to banks has already matured, with banks repaying $64 billion of TFF funding in the September quarter 2023. This was the first of 2 concentrated maturity periods, with the larger $96 billion maturity scheduled in the June quarter of 2024. Banks have managed their TFF repayments smoothly to date. As shown earlier, banks have significantly lifted their bond issuance in recent years, and in recent months, they've increased RMBS issuance too. Will their funding plans extend to a larger re-entry to the RMBS market? Put another way, while the lack of bank debt issuance when banks were drawing down the TFF provided more room for non-bank ABS issuance, will this work in the other direction when banks are paying back the TFF? A third area of interest for ABS markets is the evolution of competition in lending markets. A period of intense competition in housing mortgage markets has eased in recent months, with fewer cashbacks on offer for mortgage refinances, and variable housing loan rates for new loans are edging higher by more than the cash rate. The bank's funding cost advantage over non-banks has also diminished somewhat, with higher deposit rates as customers switch from at-call to term deposits, and there's been a narrowing in RMBS spreads. Where to from here? While a number of non-banks have proven very agile in finding markets outside of prime mortgage lending, will they maintain that flexible approach? Or will they look to consolidate their current market segments? To conclude, ABS markets have shown considerable dexterity in adjusting to change. While I'm not confident to predict how this will continue to evolve, I confidently predict that we will have plenty to recap this time next year at the ASF's annual conference in 2024. Thanks for your attention, and I look forward to your questions.
Thanks, Carl. We do have a couple of questions. The first one, the RBA seems to appreciate the role the non-bank sector plays in providing credit, but what is the optimal size and shape of the sector? For example, how many lenders, of what sort of scale and what sort of lending?
Thanks. That's a very interesting question. The Reserve Bank is a very open-minded institution. We certainly don't come in with any frame there as to what might be the ideal. Industry structures tend to work themselves out, and we certainly at the moment, the non-bank lenders have shown that they provide a very useful service for borrowers and servicing market segments that would otherwise not be getting the attention that they do get. And so this is obviously a benefit for the borrowers involved in those markets. It's always a question of how far and quickly something should grow. You're balancing off efficiency and stability considerations. But certainly at this point, the sector, while very important in the market segments that they operate in, non-bank lending is still overall not a large share of credit, around 7% of credit overall, around 5% of housing credit. And so it's not considered something of a risk in a systemic perspective.
Our second question, does the RBA anticipate growth in the SME securitisation market? And if so, will it be predominantly an ADI or non-bank market?
Well, that's an interesting question. I would have thought that this is one that perhaps all the industry participants here might have a closer view on, particularly after the discussions that you're having today. I mean, certainly we have seen a high degree of flexibility in this market, and the non-banks have been quick to adjust their business practices and to enter new markets, either through acquisitions of businesses that the banks might not be so interested in, or growing their own business in particular segments. And so I think what we have seen is great versatility of the non-bank sector, and the degree to which that will continue is one of the questions that I think will be up for deliberation this time next year, and it will depend on a range of things, the funding conditions for the ABS market, and also the degree of competition in the various markets that are under consideration there.
Thanks, Carl. And one more question. Were the outcomes of the use of the TFF during COVID as expected? What were the adverse impacts and what did we learn?
Yep, we can always learn a lot. It was certainly an unprecedented period, and the bank, with interest rates approaching the lower bound, the bank undertook this comprehensive package of unconventional monetary policy tools, and we do actively review our experience with all of those tools, and we'll be doing the same with the term funding facility once it's all done and dusted and the money is repaid. But we can certainly point to the TFF achieving its objectives. It came at a time when there was great uncertainty and we needed to get interest rates lower so that to support borrowing activity and the economy through this extreme pandemic period. As one part of a comprehensive package, the TFF was successful in lowering funding costs across the economy and supporting growth in credit and the economic recovery. So that the TFF has been successful in achieving its aims. But as said, when it has concluded, we will sit back and review all the tools, and this is something that the RBA review has asked for as well, to consider all the unconventional policy tools and to consider a framework should the circumstances ever arise where we might consider using them again. Thank you very much.